Welcome to the Radio Revenue Podcast. So I want you to look down at your feet right now. Just take a second and look.
It's always a good reality check, honestly.
Right, because whether you are currently strapped into a pair of ultra-cushioned, brightly colored running shoes that look like they belong on a lunar mission, or, maybe you are lounging around your kitchen in some cozy sheepskin slip-ons, there is a very high probability that you are wearing a piece of a $5.4 billion empire. Welcome to this deep dive.
It really is a staggering amount of capital when you pause to visualize it. I mean, we are talking about billions of dollars generated entirely from what human beings decide to lace up or, slip on before they walk out the door.
Which is such a basic thing.
Exactly. It's a fundamental universal need. But the scale at which this particular company is operating, it turns a basic necessity into an absolute economic juggernaut.
And that is our mission for this deep dive today. We are opening up the hood on Deckers Outdoor Corporation. Specifically, we've got our hands on their raw Form 10K filed with the SEC for the fiscal year ended March 31st, 2026.
And for anyone who isn't spending their weekends reading financial disclosures, which is probably most people, a 10K is not like a polished press release.
Yeah, no glossy photos here.
Right. It is definitely not a marketing pitch designed to sell you boots. This is the unvarnished, legally binding truth of the business.
Which is exactly what we want. Our goal today is to figure out how a single company manages to completely defy global consumer slowdowns and massive complex supply chain hurdles to generate just record-breaking growth. Okay, let's unpack this, because to understand how Deckers just pulled in $5.47 billion in net sales, which is, by the way, a massive 9.8% increase from the previous year, we have to look at the two radically different pillars that are basically holding this entire corporate structure up.
What's fascinating here is the brilliant juxtaposition of their portfolio. Deckers is essentially operating as a two-headed monster, and those two heads are UGG and HOKA.
Yeah, and they couldn't be more different.
Not at all. They serve completely different masters in the consumer landscape. They operate on totally different timelines, and they target entirely different psychological needs.
I mean, let's just look at the raw numbers first. On one side of the house, you have UGG, which pulled in $2.73 billion this fiscal year. That's an 8.2% increase.
That's a massive baseline.
It is. And then on the other side, you have HOK, which saw this explosive, almost reality-defying growth of 15.9%, reaching $2.58 billion.
So they're almost completely neck and neck now.
Yeah, and the rest of their brands, legacy names like Teva, are just a tiny, shrinking fraction of the business now. The SEC filing shows the other brands category actually shrank by nearly 34%. So, I mean, for all intents and purposes, this is just the UGG and HOK show.
It really is. And the contrast between those two brands is the invisible engine of the whole company. UGG represents fashion, tactile comfort, and this deeply entrenched cultural legacy.
Right, the classic California surfer origin story.
Exactly. It was literally designed for surfers to warm up their feet after coming out of the cold Pacific water. And over decades, it evolved into this premium lifestyle juggernaut that just transcends generations.
And then you have HOK.
Right. HOK represents something entirely different.
Okay.
It is built on high performance, technical innovation, and an incredibly aggressive market capture strategy. It was originally designed for ultra runners, people running 50 or 100 miles at a time, offering this massive enhanced cushioning.
They completely bucked that whole minimalist barefoot running trend that was huge a while back.
They absolutely did. And now that maximalist design is on the feet of nurses working 12-hour shifts, everyday athletes, and urban tastemakers everywhere.
I look at it kind of like a perfectly balanced investment account. UGG is your massive, reliable blue chip stock. It just keeps paying out year after year. It's a cultural staple. You know exactly what it is.
Yeah, the anchor.
Exactly. And HOK is your high-growth tech stock. It's the one driving all the exciting headlines, disrupting the established players, and pulling in those aggressive double-digit gains.
That's a really great way to frame it.
But looking at UGG specifically, if it is such a massive part of the portfolio, literally accounting for over half of their total revenue, isn't the entire corporation incredibly vulnerable to the changing seasons? I mean, UGG is globally famous for sheepskin boots.
Yeah, nobody is wearing those to the beach in July.
Right. How does a company heavily reliant on a winter brand survive the summer months without the entire operation taking a massive financial hit?
Well, that seasonal vulnerability is a fundamental risk in the apparel industry, and the 10K explicitly notes this historical seasonality. For UGG, the bulk of their sales happen in their third fiscal quarter.
Which is the holiday shopping season.
Exactly. Aligns perfectly with winter and the holidays. So historically, before their current structure, that meant Deckers had a massive influx of cash in the winter, followed by much leaner, quieter operations through the spring and summer. They were effectively at the mercy of the calendar.
That sounds incredibly stressful from a cash flow perspective.
Oh, absolutely. But this is where the HOK acquisition, which they made years ago, proves its long-term strategic brilliance.
Yeah.
HOK serves as the ultimate seasonal hedge.
Because, running, walking, and being on your feet doesn't stop just because the snow melts.
Precisely. The human need for performance footwear is year-round. HOK's sales distribution is incredibly even throughout the entire calendar year.
Oh, wow. So it literally fills the gap.
Yes. While UGG carries the heavy load through the winter months, HOK provides this massive stabilizing baseline of billion-dollar revenue through the spring, summer, and fall. They have structurally insulated their balance sheet against the tilt of the Earth's axis.
Okay, the seasonal hedge makes complete sense. But that seasonal stability actually forces us to look at the geographic map, because the geographic revenue data in this 10K really threw me for a loop.
The international numbers.
Yeah. If HOK needs to sell year-round, they need a massive global footprint. And the numbers show they are getting it. International sales grew by a massive 26.8%, reaching $2.28 billion. But U.S. domestic sales were practically flat.
Right, they barely moved.
They grew by a microscopic 0.2%, sitting at about $3.19 billion. Wait, I'm looking at this, 0.2% U.S. growth. And I have to be honest, that looks like a massive red flag.
It definitely raises eyebrows.
I mean, if your home market, the cultural engine of your entire brand, is flatlining, isn't that a glaring signal that the bubble has burst? Have we just hit peak UG and HOKA in America, and they are kind of scrambling overseas to make up for the domestic exhaustion?
It looks like a plateau on the surface, I'll give you that. But synthesizing the data across the distribution channels in the report reveals the mechanics of a deliberate, highly orchestrated pivot rather than pure market exhaustion.
So you don't think it's a panic move?
Not at all. Deckers is intentionally shifting its strategic weight to capture international territory with HOKA. To do that, they are heavily utilizing their wholesale partners. The 10K notes that wholesale revenue across the entire company was up 12.3%, hitting $3.2 billion. Wholesale acts as a megaphone in a new geographic market.
Walk me through the mechanics of that, though. Why focus on wholesale? Doesn't selling direct-to-consumer on their own website offer significantly higher profit margins? Why share the profit with a third-party retailer?
Direct-to-consumer absolutely offers higher margins, yeah. But you cannot just launch a website in Germany or Japan and expect millions of people to instantly trust a highly technical running shoe they've never physically held.
Right. Especially a shoe that looks as weird as a HOKA.
Exactly. You have to establish credibility first. So Deckers places HOKA in established, highly trusted specialty running stores and premium international retailers.
So they borrow the local store's credibility.
Precisely. They let local marathoners and sneaker enthusiasts physically touch the foam, feel the weight of the shoe, try it on. The local wholesale partner absorbs the risk of holding the inventory, while Deckers gets the brand exposure.
And then once that brand awareness and trust are established through the wholesale megaphone, they follow up with the high-margin direct-to-consumer expansion.
It is a textbook market penetration strategy. They are actively opening brand retail locations in international markets right now, converting that wholesale-driven hype into owned direct-to-consumer data and higher margins.
Which makes that 26% international growth look less like a lifeline and more like phase one of a master plan.
It's a long-term play to make their geographic revenue split as perfectly balanced as their seasonal revenue split.
Okay, so they are selling billions of shoes globally, they have successfully balanced the seasons, and they're executing a massive overseas expansion. It all sounds like a flawless victory on a spreadsheet.
But there's always a but with global operations.
Oh, big time. Physically creating and moving all of these actual products around the globe, that is where the 10K reveals some serious, almost terrifying vulnerabilities.
I want to get into the logistics, because despite all this massive sales volume we just talked about, Deckers' gross margin actually decreased slightly.
Yeah, down from 57.9% to 57.7%.
Which is weird, right? Selling more items usually increases efficiency and drives margins up. A margin drop during a sales boom feels completely counterintuitive.
It does, until you look at the gritty, physical reality of operating a global supply chain in 2026. You see, Deckers does not own the factories that make their shoes.
They outsource everything.
Everything. They outsource all of their manufacturing to independent contractors, and that production is heavily concentrated in Southeast Asia, primarily in Vietnam and Indonesia, which is great for efficiency normally.
Right. When global trade routes are calm and fuel is cheap, that geographic concentration is an absolute efficiency engine. But when the world gets turbulent, that single-point concentration becomes a major liability.
And it goes way beyond just the location of the assembly lines. It is the extreme specificity of what the shoes are actually made of. Here's where it gets really interesting.
Oh, the sheepskin supply chain?
Yes. The 10K details that sheepskin, which is the literal lifeblood of the $2.7 billion UGG brand, is sourced primarily from Australia. But you can't just take the fleece off the sheep and put it on a foot. It has to be treated and processed. And according to this SEC filing, the vast majority of their sheepskin is processed by just 2 tanneries in China.
2 out of the entire world.
Just 2. It blew my mind.
The bottleneck risk there is immense. We are talking about a multi-billion-dollar product line dependent on 2 distinct physical locations for its core raw material.
It's terrifying from a risk management perspective.
If anything happens to either of those facilities, a local labor dispute, a regional power grid failure, sudden regulatory shutdowns regarding water usage or chemicals, the production of the entire UGG brand comes to a grinding halt.
It is exactly like an hourglass.
Yeah.
You have all the sand in the world at the top, representing this massive global consumer demand for the boots, and you have this incredibly wide base at the bottom, thousands of wholesale retail stores and DTC websites ready to sell the product.
Right.
But the entire system depends on the sand getting through that tiny, fragile neck in the middle. If those 2 Chinese tanneries clog up, the entire system stops. Not because people don't want the product, and not because the stores can't sell it, but because the raw material cannot flow through the bottleneck.
And sheepskin isn't even their only hyper-specific material.
No, the filing also highlights their heavy reliance on sugarcane-derived EVA for shoe components. For anyone listening who doesn't spend their free time dissecting shoe midsoles, what exactly is EVA and why is it a supply chain vulnerability?
So EVA stands for ethylene vinyl acetate. It is the highly elastic, foam-like polymer material that gives modern running shoes their shock absorption.
The squishy part of the HOK?
Exactly, the squishy part. In HOK's case, a specific, specialized EVA blend is what provides that signature, cloud-like bounce and massive cushioning. It is the literal foundation of their performance claim.
So they can't just use whatever cheap foam they find.
Sourcing this specific, sugarcane-derived EVA at the massive scale Deckers requires means they are reliant on highly specialized chemical suppliers. You cannot just walk into a local hardware store and replace your EVA supplier if a shipping container gets delayed.
Which brings us right back to the mechanism of that slight dip in gross margin. Moving a specialized EVA and Australian sheepskin through Chinese tanneries and Vietnamese assembly lines, and then shipping the final product to a store in Chicago or Berlin that requires a flawless global network.
And the global network is anything but flawless right now. The margin dip is the direct mathematical result of incremental tariffs on imported goods, particularly the cost of bringing finished goods into the United States.
And the 10K gets pretty explicit about this.
Very. They warn investors about the heavy financial burden of international tariffs and geopolitical conflicts. They specifically cite tensions in the Middle East causing shipping route diversions.
Because ships literally have to go the long way around.
Right, which instantly increases lead times, spikes energy costs, and inflates raw transportation fees.
It's essentially a geopolitical tax on every single pair of shoes.
That captures the reality perfectly. Deckers implemented strategic price increases on their products, and they negotiated cost-sharing arrangements with their suppliers to try and mitigate these impacts, but the geopolitical tax is relentless.
It just chips away at the bottom line.
It is actively biting into their profitability. I mean, they are selling more shoes than at any point in their history, but it is costing them proportionally more capital to physically get those shoes from a factory in Vietnam onto a customer's foot in California.
That reality forces a massive question about capital allocation. With supply chain costs constantly rising and global trade becoming like a literal minefield, how is Deckers allocating their mountain of cash to ensure they keep winning?
They are making some very distinct choices.
The 10K shows management is executing 2 plays. They are aggressively trimming the fat, and they are betting an unbelievable amount of money entirely on themselves. First, the trimming. The filing notes they're actively phasing out the standalone operations of smaller brands like Koolaburra and AHNU.
And we know they already sold off Sanuk in the prior year.
Right, so they are essentially clearing the decks of anything that doesn't say UGG or HOKA on the box.
Which is smart, because maintaining a niche brand is an incredible, often hidden drain on back-end corporate resources. You weren't just designing a few different shoes.
You need a whole infrastructure.
Exactly. You have to maintain entirely separate marketing teams, distinct supply chain sourcing for different aesthetic materials, separate e-commerce platforms, and you're taking up valuable physical shelving in your global warehouses.
And when margins are getting squeezed by tariffs, you can't afford that.
In a complex macroeconomic environment, distraction is a liability. By shedding or absorbing these smaller brands, management is freeing up capital, personnel, and warehouse space to focus completely on their proven multi-billion-dollar winners.
And speaking of freeing up capital, this next data point genuinely blew my mind. Despite pulling in over $5 billion in sales, Deckers did not pay a single cent in dividends to their shareholders. Zero. Instead, they repurchased a staggering $1.07 billion of their own common stock in fiscal 2026 alone. So what does this all mean? If you are a listener who doesn't actively trade Deckers on Wall Street, why should you care about the mechanics of stock buybacks and the death of niche shoe brands?
If we connect this to the bigger picture, it reveals the modern reality of corporate survival in an unpredictable world. Pumping over $1 billion into stock buybacks rather than paying a quarterly dividend sends a very specific, aggressive message.
It's a huge flex.
It really is. The mechanics of a buyback are simple. The company uses its own cash to buy its shares on the open market and retires them. This reduces the total number of outstanding shares, which mathematically increases the value and earnings per share of every stock still held by investors.
So they are betting on themselves.
It signals supreme management confidence. They believe the absolute best, highest return investment they can make right now is in their own future.
And they avoid the trap of the dividend expectation.
Exactly the point. Dividends create an unyielding expectation of regular quarterly cash payouts. Once you start paying a dividend, Wall Street punishes you severely if you ever cut it.
Because it looks like you're running out of money.
Right. That rigid expectation can severely restrict a company's cash flow during unexpected hard times. Buybacks provide total flexibility. They are maintaining the agility to weather sudden economic storms like a sudden spike in those tariffs and supply chain costs we just discussed, while still returning immense value to their shareholders.
It is a fortress mentality. Keep your cash flexible, ruthlessly eliminate distractions, focus only on your strongest assets, and control your own destiny. Which really brings this entire analysis full circle.
It does.
Deckers has masterfully insulated itself against economic trends with a pristine balance sheet. They've hedged against seasonal slumps with HOKA, and they are navigating consumer fickleness by balancing legacy fashion with technical performance. But looking closely at the risk factors buried deep in the back cages of this 10K, it becomes clear that nature and technology are much harder to build a fortress against.
This raises an important question about the limits of corporate strategy. The 10K highlights two specific systemic risks that go far beyond consumer preferences or supply chain logistics. The first is climate change, and the second is artificial intelligence.
The climate piece is fascinating because it ties directly to the core identity of UGG.
We discussed how UGG relies heavily on the winter season for its massive cash influx. The SEC filing explicitly notes the risk of unfavorable or unexpected weather patterns, which are being intensified by climate change.
Which makes sense. I mean, nobody buys sheepskin in a heat wave.
It is a simple, unavoidable reality if global warming leads to consistently shorter, significantly milder winters across North America and Europe. How long can UGG's seasonal dominance last?
That is a terrifying thought for them.
You can hedge against a bad economy with smart pricing, but a brand built on the tactile sensation of warmth is inherently threatened by a warming planet. You cannot market your way out of a winter that never arrives.
It is an existential threat hidden in plain sight. And then there is the AI risk, which attacks the other side of the business, how people actually find the products in the first place.
The 10K notes the rapidly growing reliance of consumers on third-party digital platforms and vast online marketplaces. These platforms are increasingly utilizing complex AI algorithms to dictate search results, moderate content, and ultimately decide what products consumers actually see on their screens.
So the mechanism of success changes. It is no longer just about whether your shoe has the best EVA foam, or the warmest sheepskin. It is about whether a black box algorithm decides your product is relevant enough to show to the customer.
Precisely. If an unseen algorithm suddenly shifts its parameters to prioritize, say, sustainable materials over premium comfort, or if a digital platform decides to heavily favor its own private label brands in the search results, a juggernaut like UGG or HOKA could instantly drop off page one.
Completely out of sight.
Can a brand built on the physical sensation of comfort translate its success into a digital marketplace curated entirely by code? If traffic and customer acquisition costs swing wildly because of an algorithm update, that is completely outside of Decker's control.
It really leaves you to ponder what the future of the entire apparel industry looks like. We are rapidly moving into an era where the continued success of a multi-billion-dollar footwear empire might be dictated less by the quality of its rubber and leather, and more by shifting global weather patterns and the invisible, unpredictable code of digital search algorithms.
The terrain is fundamentally shifting underneath them.
It is a wildly complex landscape, and it perfectly underscores why they are hoarding cash and focusing only on their absolute strongest brands. They are bracing their fortress for a future that is incredibly hard to forecast.
It's going to be fascinating to watch.
The next time you lace up a pair of HOKAs for a run or slide your feet into some UGGs on a chilly morning, just remember that you aren't just wearing a shoe. You are wearing the end result of a masterclass in global logistics, seasonal hedging, and ruthless corporate strategy. It was a Revenue Radio podcast. Thank you for watching. Please like, subscribe, and hit the bell to stay updated with our latest analyses.